This one pisses me off the most. There is a moment that happens every year with small business owners. It usually happens right after relief. You finish the year, you've survived it, you show a profit, and like clockwork, you pick up the phone and you call your accountant. You have one simple question: how do I reduce my taxes? And almost every business owner hears some version of the same answer. Go buy something. Go buy equipment, buy trucks, upgrade technology, prepay expenses, make it a deductible. The advice sounds smart. It feels responsible. It feels like you're playing the game correctly. It feels like you're beating the system. But in many cases, that single sentence was quietly done more damage to the business than almost any other piece of advice you could get. And here's why. When you buy something for a tax deduction, you're not eliminating the cost, you're only reducing it from your marginal tax rate. Let's slow it down for a second, because this is where most business owners misunderstand what is actually happening. If you have, let's say, a combined marginal tax rate, both federal and state, of roughly 33%, and let's say you spend $1,000, you don't get to save $1,000 in taxes, you only save your marginal tax rate. That happens to be $330. That means you just spent $1,000 to save $330, and you're still out the $670. That is not tax efficiency. That is a net cash outflow. And yet, owners celebrate it as a win. Let's make this more realistic. Most of the time, that purchase is not paid with cash. It's actually financed. And now the math gets worse. You didn't just reduce cash this year, you increased debt for the next 3 to 5 years. You added monthly payments. You added interest. You added fixed obligations. And here's the part almost nobody checks before that decision. Does the business actually have a surplus of cash after debt service? Because in a shocking number of small businesses, the answer is no. The business may show a profit on paper, but once you account for existing loan payments, equipment financing, lines of credit, credit cards, owner distributions needed to live, there is no real excess cash left, which means the business never truly earned the profit it showed on a tax return in the first place. Now pause there. If the business did not generate surplus in cash after debt service, and now you add an additional debt to reduce taxes, you didn't reduce risk, you increased it. You turned a tax problem into a cash flow problem. And the cash flow problems are the ones that kill businesses quietly. This is where accounting logic and operating reality collide. Accounting looks backward. It tells you what already happened. Cash flow looks forward. It tells you whether the business can survive whatever's coming up next. Your tax return may show profit, but your bank account tells the truth. And when an accountant gives tax advice without modeling cash flow, debt service, the owner lifestyle, all those needs together, the advice is incomplete. It does not make your accountant bad. It means that they're doing what accounting is designed to do: compliance, IRS compliance specifically. But compliance is not the same thing as safety. Now let me be very clear. This is where the nuance matters. I'm not saying you should never buy assets for tax reasons. I'm saying it only makes sense when very specific conditions are met. Condition number 1, the asset must directly improve the productivity or the profitability, not convenience, not ego, not it would be nice to have. Condition number 2, the business must have a real surplus of cash after existing debt service, not profit, cash. Condition 3, the purchase must align with a long-term operating plan, not a December panic move to avoid taxes. If those 3 conditions are not true, you're not executing a tax strategy. You are reacting emotionally to a tax bill. And emotional decisions around money are almost always expensive. This is why so many business owners experience the same confusing pattern year after year. They show a profit, they pay less in taxes, they buy more stuff, and yet somehow they feel poorer, more stressed, more exposed, and more trapped. Because profit on paper does not equal financial strength in reality. A business can be profitable and still be fragile. The goal is not to avoid taxes at all costs. The goal is to build a business that can safely afford them. If you have to borrow money to reduce your tax bill, the business is already telling you something important. It is telling you that profit exists only on paper. And until you reconcile that gap, no amount of deductions will make the business feel secure. That is the difference between running a business and surviving one. That's it for this week. I hope to see you on the next one. Until then, stay profitable.